Welcome to Build a Business Worth Buying, the podcast where seasoned entrepreneurs, M&A experts, and world-class operators share behind-the-scenes stories of building, scaling, and selling remarkable businesses. I'm your host, Aaron Allpeter, and every week I sit down with people shaping the world of acquisitions, founders who cashed out, buyers with bold strategies, and advisors who help make deals happen. This is not a podcast for beginners. It's for those who know the grind and want actionable insights to make their next big move. Get ready to take notes, rethink your strategy, and hear untold stories of what it takes to build a business worth buying. Today's episode takes us into a different landscape than our usual brand-centric conversations. We're talking about exits in the world of physical assets, trucks, warehouses, logistics networks. And really, what does it take to build a business worth buying when your most valuable asset is in the infrastructure, not just your identity or narrative? Joining us today is Peter Stefanovich, co-founder and managing partner of Left Lane Associates. Left Lane Associates is Canada's biggest M&A advisory firm for the supply chain sector. Peter co-founded the firm in 2016 after more than 8 years in operations and business development at Radiant Logistics in Toronto and RMS in Chicago. Since its founding, Left Lane has become the go-to boutique M&A advisor for transportation, logistics, and warehousing, facilitating deals all across North America. In today's conversation, we're going to explore where brand builders and asset-heavy operators share common ground, where their paths diverge, and we'll also dive into what truly matters when scaling and exiting businesses on physical infrastructure and what lessons brand founders can borrow from this discipline. So Peter, first up, thank you so much for being here today.
Thank you. Appreciate it, Aaron. Thanks for having me on. Look forward to chatting.
Yeah. Just to dive right in, I'd love to get your perspective on what are the universal factors that drive enterprise value, whether it's a consumer brand or a physical service business.
So there's going to be a bunch of different factors there, but you're looking at, specialization is the biggest key, right? So enterprise value is essentially, it's a math formula to figure out, what the value you're going to get when you sell your business. And in the transportation, supply chain, logistics industries that we focus on, it's having any specialization is going to be key to driving that enterprise value and having something that's specialized enough that other parties that might be in the space are looking to expand into and get something that's very sticky for their clients. And I think that's what they're looking for, right? So there's a lot of things that change the value from a lower value business to a higher value business. We'll get into that later, but it's, enterprise value is a scale. It's based on, again, the value that you are to another, transportation other business too.
Yeah, kind of sticking with the transportation angle, is there something that's just completely different from people who may be listening and are used to what brand acquirers look for? I guess, where do those paths diverge between an asset-heavy company versus just a brand-heavy company, if you want to call it that?
Yeah, well, you're going to look at the assets themselves of the transportation business and the capital expenditures that are used to generate revenue and generate, net earnings, net profit into EBITDA. And in an asset-based trucking business, you have tangible assets that you have to replenish those assets over a cyclical amount of time in order to continue to retain that value, right? So, it's unlike other businesses or asset-light businesses or no asset businesses. In the trucking standpoint, from an asset-based trucking standpoint, it's very cash-heavy, and margins tend to be a lot less than what it would be on a non-asset-based business because you're having to replenish or refresh or buy new or buy used assets to continue on with the growth that you're building, right? So it's a space that's very dependent on cash flow. And you might be a business that's extremely profitable, but there could be cash crunches because a shipper might withhold payment or might take 90 days or 120 days to pay you, right? When you're paying your carriers every 30 days. So there's often some unique nuances when you're dealing with a transportation business than you would with any other businesses too. So those cash crunches end up being how you live and die in the transportation space. So it's cash flow is everyone hears the term cash is king. Cash flow is king in transportation logistics, for sure.
And I guess, when you're coming to value a business, would they rather take something that's a little bit more stable from a cash flow perspective or something that is more profitable? I guess, where would you rank profitability over cash flow in that case?
Well, I think it's going to be a combination, right? So when a purchaser is looking at a business to buy, they're looking at historical consistency, right? So if they see, call hockey stick growth or, huge piss and peaks that go into, let's say, your financial history, they start to ask, is it stable, right? And what any investor is looking at is a baseline to be able to say, this is where the business sits and where it's consistently going to be sitting. So they're going to need to look at that so that they could do out their pro forma math to look at any of the financial, trajectory that they're looking at themselves, and the math metrics they're looking at funding the deal, right, from debt financing or other ways of financing the deal. So they need to be able to understand that so they could project out to whether if they're borrowing money to buy the company, or if they're just looking at their lenders themselves and have certain debt covenants and other pieces of their business. They have to look at that from a forward-looking perspective. So they need to understand that, and having that baseline stability, I think, is vital. This business is very volatile, like especially with COVID. During the COVID time, there's huge growth trajectory, and that's a lot of other businesses, manufacturing and other sectors, huge growth. But then after, there's a huge pith there, right? So that peak went down because then people already overbought and they didn't need to buy anymore. And there was a huge gully at the bottom of it. And that led to where we are still today, is a little bit of a freight recession. So there's been a freight recession in transportation logistics in North America since really, people could peg it at March 2022 when the interest rate started to creep up. We tend to look at it July 1st, 2022 till present. So it's been just over 3 years of a freight recession. So, there was some time period when we're starting to see sort of green shoots coming out that we're getting rid of that freight recession, and companies were starting to see some positive volume and rate increases in kind of the late fall. But then as soon as the tariff stuff started hitting, then that obviously killed that momentum and really brought it back into that recessionary standpoint for the kind of supply chain industry in North America. So I'd say stability is key, but the problem ends up being it's just a very volatile time, obviously with the current environment with international trade policy and such. So it's tough to find stability.
That's interesting. It almost sounds like you're saying that slow growth is probably more advantageous than fast growth, at least in this particular industry. Would you agree with that?
Yes. Any purchaser, and give a background too, like half of our clients are buy side, so clients hire us to buy businesses for them, and half of our clients are sell side, where companies hire us to sell their businesses. So we see both sides of both sides of the table there, and when a purchaser is looking at things, they're looking again at that stability, right? So a seller might have huge growth, but you're not basing out. If that growth was 3 years ago, it's irrelevant. It's what is it today, and what does it look like the next 6 months out? And if you can't have that stability there, then it's going to scare people off and say they're not interested. So anytime anybody buys a business, it's really, and forget supply chain for a sec, they're really looking at a risk analysis, and they're sitting there thinking, how much risk is it going to be for me to make 2 or 3 or 4 times return on this asset, whether it's a trucking company, logistics company, warehouse. So they're looking at, how can I make my money back and make 1, 2, 3, 4 times return? So ultimately, they're trying to figure out the risk that's associated with that. And that risk could be internal risk, or it could be employees, it could be systems, it could be IT infrastructure, it could be a number of things. But it could also be, that's the micro, but it could be macro, right? Because what's going on in the tariff stability? Is there stability? Is there not stability? Is there trade deals happening? Are people manufacturing things now? Are people manufacturing in other locations? Are the lanes that you used to cover different because of the change in tariffs? So there's all these things that people are looking at, doing a full risk analysis to understand, is this worth it to buy? So when you see inconsistent kind of results, it scares people off. And when you scare people off, there's less people that are interested in buying the business. And you never want to be in a situation where, yes, you might have phenomenal years, but then the next year it's nothing. Then a phenomenal year is then nothing. Because that's going to scare a lot of people off. And you're going to have more potential suitors from a buy side perspective if it's consistent. Then you're going to have those piss and peaks all day long.
Yeah. Zero growth, just dependability and consistency sounds interesting. When you meet a founder in this space for the first time, what are some of the biggest misconceptions they have about just preparing for an exit or growing to build something that someone else wants to buy?
I think most founders, and that's irrelevant of the industry, most founders tend to think that they have a higher value than what their business is actually worth. And I think that's common, and that's human nature, and that's nothing to do with anybody. It's often when it's something that you've built and you've grown yourself, most people, I'd say for sure over 90% of people feel their business is worth more than what it truly is. And we often like to remind people it's best to get a valuation, or to review as an independent third party ourselves, review their business financial, kind of the financial financial background and look how their business is trending and what it's worth. And for us, sometimes it's very hard for people to see, somebody say a number that's less than what they anticipate. We justify it by showing here's the reasons why, here's what the market's showing, here's the macro, the micro market, here are the reasons why why this business is worth X, and we're able to justify it. But again, it's still hard for people to hear that. So often people, as a misconception, they think their business is worth more and their business will sell right away. So those are two big things. So there's a value expectation gap generally, and there's also time expectation gap. And often people think that selling a business is relatively quick. It can be if you have all your materials in order, you have all the backup data, you have all your financials done, you have audited financials, every box is checked. You're operating like a Fortune 100 company, publicly traded company. Yes, you can move fairly quickly. But most businesses are privately held, have never done this process before, don't have all their financials in order, don't have all their operational diligence set up, don't have handbooks put together. They're creating a lot of this stuff when we're working with them to help sell. So it takes a lot longer than people anticipate. And on top of it, I think it's important to plan ahead so that way when you start to think about getting ready to sell, as long as you start mapping out what you need to do and do it slowly over time, that releases the burden that you have to do it while you're still trying to run the business. And we always try to remind people to think about plans, and we help them with this, help them get sell ready, so when it comes time, they don't need to rush to do that, and they can still focus on their business and not spend too much time on the M&A, because they leave it to people like us to help them do, as opposed to them creating new documents, creating new systems. If it's already in place, then it should be fairly easy and fairly quick. But generally speaking, it takes a lot longer than most people anticipate, and their businesses are often valued at less than what they originally anticipate. It's not because they don't know any. It's because they're not in this space. They don't know
Sure.
really what the market's bearing. So that's our job, is to be, industry insiders and be the sort of intellectual capital to share with them. This is what's really happening. Now, they might not like to hear it, but it's better to give reality versus idealism. So it's better to just be honest and open about what it is.
I imagine that can be a difficult conversation, and you're beginning a relationship with them where it may take several months, several years to sell this business. And so what advice do you give them in terms of like, hey, you don't like this valuation today, here are 2 or 3 things that you can start to work on that will help put that valuation in the right trajectory you're looking for?
Absolutely. No, there's a couple key factors that we always recommend for people to do, and we have some programs internally we help work with them on. But really, it's looking at customer dependence. So is their customer concentration very high? Okay, well, here are your top 5 customers. Well, great. Well, you're not saying get rid of those customers, because in order to decrease your customer concentration, but find new customers, find other ways. Don't be dependent on that one customer, right? Like, there's oftentimes that people just say yes to things because it's easy, and not like it's going to damage the relationship. So, but instead of taking on another 500 loads from this shipper, you could say, look, we're kind of maxed out. We could help you on certain specific lanes, but then start using that capacity you might have with another potential shipper, or find new potential shippers, right? So that way de-risk your position for that one customer, right? Again, when I was talking about earlier about the cash flow crunch, is imagine you have that customer that's sitting at 50% of your entire business and they're taking 120 days to pay you. That's crazy. It would be way, way, way better if you had that one customer that's 10% of your business taking 100 days to pay you. So it puts way less strain. So having that customer concentration lower is key. Having the risk dependence on, it's called key person risk. So risk dependence on the owner of the business, being heavily involved in the business. That's another key thing. So lowering that, and that's, like I say, easy to do, because as a founder of a business, most people want to be heavily involved, or be, understand what's going on, or be, very hands-on. And it's very tough for people to pull that away. But it's having somebody be less involved increases their value, and allows you to leave the business earlier when you sell. So we always remind people, the less involved you are, the more you offload, the more that you incorporate with other team members in your team, the quicker you are able to exit, versus you have to stick around for 2 or 3 years after a transaction. So it only helps them. right? So it's difficult when you're doing it, but once it happens, like they're very thankful for the advice we share. So getting the key person risk lowered. Also supplier risk, right? And that could be for any industry, but in transportation, like if you're a freight broker and you don't have any assets and you use 3 carriers to move all your freight. So use 3 trucking companies to move all your freight. Well, if one of those trucking companies goes bankrupt or something happens, then again, similar to customer concentration, you have a supplier concentration risk. Then that's scary as well. So you never want to be in those situations. So those are kind of the key things that we walk through people on how to lower the risk profile. So that way, the lower the risk profile happens, the higher the value a buyer puts on you, right? So it's like a teeter-totter, right? So lower risk, higher they pay, right? Higher risk, lower they pay. So that's always what you want to be able to get to somebody paying more for your business, because it's an easy sell to investment committee or to a bank to say, hey, look, this is great business because of X, Y, and Z, right? So, and when it's positive, they pay more.
Yeah. Do you have any particular benchmarks that you have people look at? So, do you want your top 5 customers to make up 50% of your business or 10% of your business? I mean, what are the goals there?
Yeah, it's really it's dependent on certain size thresholds, right? So if you're a small business and you're doing a $3 or $4 million of revenue, and you're probably going to have an anchor client. You're going to have a client that's your main client. But as you get bigger and scale larger, that percentage should decrease, right? So that customer that might have been 100% of your business day one now is 50% after year 2. Now then it should continue to slowly decrease, but it should never increase, right? So it should continue to decrease. So really the thresholds are based off of kind of revenue and the age of the business. But kind of by year 3, you shouldn't really have any customers. By like year 3 of a business, you shouldn't really have any customers larger than 50%. It should be less than that. And ultimately the goal is to get to your customers to be single digit as a percentage of your business. So, less than 10%. Now, sometimes that's very hard, but if you could get into the low double digits, like kind of the low teens or sub 20%, that's key, right? As soon as you get above 20%, then that raises the red flags for a lot of the potential purchasers. So just having that as a lower concentration number is key, but it does take time. And that's, again, the same thing I talked about, misconception on how long things take. It takes a lot of time to be able to change that, right? Again, that's years. That's not months, etc. Right? And that's you finding new business to lower that risk, right? And it's also not finding new business in one customer, because then you're just creating. You're basically, it's a shell game. You're moving one shell to the next. You want to lower risk overall by having multiple different new customers, not just one new customer, right?
Yeah, a lot of times I'll talk to folks and it'll be like, do you have this repeatable sales engine? Are you able to go out and find people and nurture them? And maybe you're landing smaller accounts, but they're able to grow with you and things like that. So that definitely resonates with me. I guess, like, what's the opposite end of that? Where do you come across things where founders are like, oh, I really got to work on X, Y, and Z thing. And you're like, hey, people don't really care about you having a new logo. So how often are you talking people out of doing things that don't really move the needle for a buyer?
Yeah, like I wouldn't say too often, but there are definitely things that don't add a ton of value. It's just like in real estate, right? If let's say your basement and changing the color paint to red from blue isn't really going to change the price of it, but if you're adding a washroom, it will. So similar to a business, it's if somebody's changing, let's say their accounting system isn't going to have a huge major change, right? Or even sort of in the space that I live in the supply chain business, a lot of the marketing branding doesn't heavily change based on, kind of what somebody changes, right? If they're doing zero marketing to doing some marketing, it's not going to move the needle, really, minimal, right? It's mainly looking at the financial stability of the business, the financial background of the business, against looking at the type of customers that you have, the length of those customers, so the longevity of those customers, and understand the type of businesses that they might be doing, if it's specialized versus generic, commoditized freight moves, right? So for most people, it's focusing on those pieces of the actual operations. The branding and marketing tend to have a lower value metric when you're looking at it from an exit perspective. So changing a marketing plan may not move the needle, or changing your accounting system is not going to move the needle. But what I would say with those pieces that say won't move the needle up, they can definitely move the needle down. So there's an inverse effect there. So if you're doing no marketing and you're not generating new clients or new leads because you don't have a good marketing engine, then that's going to hurt your business, right? So they may not move the needle up, but they're definitely can move the needle down if you're not doing things, right? So, I don't recommend people not doing things. The value, spending $1 million on marketing is probably not going to move the needle versus spending 100,000. But if you're doing zero, it's going to hurt you. So there's that kind of threshold. You should be doing something. Usually, if you're asking yourself, should I be doing something? The answer is usually yes, right? So in some of those circumstances, you definitely should be, focusing on things. But it's again, I wouldn't be spending, hundreds of thousands of dollars switching to a new accounting software system before you transact, right? It's probably not worth it unless there's some absolute reason you need to. So those are the things I probably would steer away from, spending a huge amount of capital and energy on just before you sell.
Makes sense. I want to go back to something you said a little bit earlier, just around the capital intensive nature of the businesses that you're working with. And these asset heavy companies, they have really unique capital structures, whether it's fleet upgrades, warehouse leases, maintenance on equipment, things like that. How does the timing of these expenditures impact the attractiveness of an exit?
Well, I think from any expenditures you do, it has to be consistent, right? So that same thing that we talked about earlier, consistency. And if you're not spending the same amount typically year over year, like within a certain ratio, then a purchaser might sit back and say, well, here's the big thing. You didn't do this because you're planning on selling, so we're going to have to normalize that down. So that's actually going to affect your sale price because you're purposely doing this in order to save money for when you sell. So most buyers are sophisticated and they're going to see those things. So you want to make sure that what you're typically doing is consistent, right? If there's a reason behind that and you're not doing it because it didn't work, or let's say you hired a consultant to help do something, your sales strategy, and you hired them for $200,000 a year and they haven't produced anything over 2 years, and you stop paying them and say, look, we don't need you anymore, that's justifiable. But if you don't do something just because you don't want to do it in anticipation of selling, almost any buyer is going to pick that up and ask you why. And if the answer isn't justified, then they're going to lower the purchase price because of that. So it's the same thing about the consistency piece that needs to be kind of filled in.
Is the inverse of that also true, to the sense where if you're just spending money to spend money to be consistent, but you're really not getting a good return on that, would that also knock down your purchase price? Or are they going to look at that and be like, wow, you're really efficient in your spend, you're spending way too much on forklifts, we know we can get a better deal, and that actually makes you more attractive in their eyes?
It has some bearing, but very little. In essence, like if somebody's going to go, like a purchaser when they're buying a business, especially a trucking company, let's use that example, where they're buying forklifts or buying power units or trailers, when they're going to go do that, they're buying you because they could find cost synergies, yes, but also growth synergies. That's what they're excited about. Not so much about the cost synergies, but let's say you go buy a power unit for, like, let's say I'm the seller and you're the buyer, and I'm buying the power unit for like $200,000. Well, you as a purchaser probably have a larger economy of scale, and you could buy that for $180,000. But the difference of him buying 10 of those at a delta of $20,000 a truck, that's $200,000 savings. The purchaser is going in knowing that any future purchases they'll be saving on doing that, and that's what they're putting as their value metric when they're putting they're called their indication of interest or the letter of intent together to look at buying your business. So they're already doing that math internally to see, like, we could save X and we could get this company from 5 million of EBITDA to 6 million of EBITDA year one without doing anything other than saving on petrol, saving on insurance, saving on buying power for buying trailers, buying power for power units, etc. Right? So they're already doing those metrics. So it's not going to have a dramatic impact on things. For a purchaser, once they close a transaction afterwards, they're going to look at those things immediately to see how can they save money, right? And it's not about slashing jobs or getting rid of people. It's more about, how can we, like, low-hanging fruit again is insurance, petrol, like gas. Could be having the same accounting system or having the same transportation management system or warehouse management system. So instead of having 2 licenses, you have 1, right? So there's all those kind of cost savings that somebody could find, right? It's usually afterwards.
Since you do both buy side and sell side, I'm curious, from the buy side, how often do those assumptions around cost savings or synergies actually play out to be pretty close to what they expected. It feels like you always hear about, people wildly missing on things, and there weren't the synergies they were expecting.
It's I guess it goes back to the like certain valuation gaps, right? So like our job is to give the reality of what various situations are, and if people don't factor that in and have their own metrics that are outside of what's market, then they could see those inconsistent kind of understanding of what they're looking at, right? So I guess it really depends. Is the best way to answer it. It's things like that do happen, but I mean our job is to mitigate those wild pits and peaks, right? Just when I keep talking about the consistency, our job is to make sure that how somebody buys and how somebody sells is consistent, right? So people want to see that consistency, whether they get a loan from a bank to do a transaction or not. It's that consistency helps people map out the go forward basis, and I think that matters no matter what.
Yeah, you've talked a lot about just dependability, reliability, consistency, those sorts of things. And I'm wondering if you were to start advising a consumer brand founder, are there any principles from this asset-heavy life that you live in that you think that these consumer brands should be leaning on in order to make their businesses more attractive?
I think it's you should probably be doing like any year, like going through like a kind of a self audit, right, of your business, right? Like what can we do to get better? How can we do to get things refreshed, etc. Whether it's your website or your marketing, or like you should have an internal time, like pick a time of the year, like most fiscal year ends or calendar year ends, right? So it's like kind of January 1, December 31. So it's always good to reminisce about the business and what you're looking for your own business. Kind of that time when it's there's family time, it's the holidays, and you look at your business from kind of like a 30,000 foot view and say like, what can we do better, right? What can we do differently? And so you should be doing those audits. I'd say for sure at least annually. Probably hopefully sooner than that too, but you want to be able to audit like how you're doing things and whether you need to change things or update things, etc. Now you shouldn't be doing it for the sake of just doing it, like that's just don't change just to change, like it's then it's just it's got to be for a reason. But if something is not improving or is getting worse, then you need to jump on it right away. Like don't wait for like, hey, I've got 6 months to wait before I have a week to review what I'm doing this. No, like as a small business owner, most of these companies, you should be able to act right away, like today, right? So, and not sit on things, right? So that's kind of the advice I give.
I feel like it's solid advice. I imagine that can also be a little bit intimidating for a business owner. If they're looking at this and say, man, I've got this concentration of clients. I'm really not growing as quickly as I want to. It seems to me that they would try to fix those things in and of themselves, but inherently what you're saying is you take a step back and reapproach or rethink how they're doing it. So is there any advice, anything that you've seen or you've helped people do that really helps them bend the trajectory of the business?
Yeah, I think it's going back to the kind of metrics on really focusing on getting themselves out of the business, right, and making sure other people are there. So what often that happens, not only does it give you more time, it gives you more time to think about working on the business versus in the business. So then you could start looking at how to improve things that you never actually had the time to because you're so ingrained in it. So now you can see, oh look, here are things we could change and update in order to make this business better or more marketable, right? And maybe you're not doing marketing. It's like, oh geez, because I was doing day to day and moving skids on, calling up trucks and finding people to put our shippers on various trailers, I hadn't had time to think about marketing. But we missed all this opportunity of finding new targets, finding new shippers because we didn't market. But until they take that step back and have the time to take that step back, they may not ever see that. So it's really getting an understanding of moving themselves away from the business, taking a step back so they could actually, it's a misconception to find if you take a step back that you're removing yourself from the business, actually you're actually getting more involved in the business because now you're seeing it from a holistic standpoint instead of a very narrow focus, right? So I think that's what people tend to miss, that now you get to see, here's your business as a whole, how can it make it better as a whole versus better as a, kind of a line item, right?
Yeah. What are some of those first things that you encourage people to give up so that they can take a step back?
Well, I think it's giving people the ability to make decisions without you, right? And I think that's you have to have the right people. So you can't just give somebody you hired yesterday, say, great, make all my financial decisions for me. Probably not a good decision.
No.
But if you have somebody that's been around, that knows you well, and you know them well, and you know that they're going to make the right decisions, give them authority to make those decisions. You have to give people the ability to make mistakes, right? It's not going to be perfect. I'm not perfect. You're not perfect. Nobody's perfect. And you got to let people make mistakes so they can learn. If you don't make mistakes, you don't learn. So those people need to make those mistakes, and you need to give them the ability to make those mistakes. Now, what you could do is help make those mistakes smaller, so you don't start giving them major decisions right off the bat. Say, hey, look, there's a 50% customer. What should we do? Right? You might want to start with, like, here's a customer that's 5% of your business. Like, start with that, and you build up, right? So it's just like anything else. You want to be progressive with how you manage things, and just like giving that, call it ownership to make decisions, I think is important. So giving people that kind of progressive nature of making decisions so that they can make those decisions without you, right? So having that decision capability without having you to sign off on things is key. That's the evolution of a business, because now you know that other people could run the business without you. So if something happens to you, that business still runs. You never want to have that key person risk so high that if you get hit by a truck, pun intended, then let's hopefully not that happen. Hopefully that doesn't happen. But if you do get hit by a truck, your business doesn't fail, because as a business owner, you have employees that depend on you, their mortgages, their families, their schools, everything depends on you. Like, you should never want that for your family or anybody else's family. So that way you should want to make sure that you step back to allow others to make those decisions, so that if something happens to you, God forbid if that happens, if that happens, it allows people to continue on without you. And that's really, you're creating redundancies for yourself, right? And that's really what you want.
Yeah. Now, that reminds me, my first job out of school was at Unilever. I was there for about 5 years and had really carved out this niche. And when I said I was leaving to go join my first startup, I gave them 2 months notice, because I was like, how in the world are they going to be able to do what I'm doing? That's how naive I was at the point. And I was just, kind of shocked and a little bit dismayed, where they're like, yeah, we're fine. Like, we've got a process. We've got all these things. We're not going to miss a beat. And that was a really insightful moment for me to recognize that, these big companies are big for a reason. They've gone through that. And so I guess my question to you on that is, the counter argument would be that when you have something like that, where you have all this process, you kind of lose a little bit of your soul as a business, and maybe you're not moving as quickly. Maybe you don't have as much of a special sauce as you could have had. What's the right level of that bureaucracy that you think a founder needs to have in their business, in order to have something that somebody else wants to buy and is excited about buying, versus something that's super slow and bogged down?
I guess put it in a different fashion, so that way, because I want to go in a different trajectory. So what would be a better way of saying that, so that way I could kind of fill
Sure.
in, like.
I think what's the right level? How do you know if you have a founder that has the processes set up? Because someone may say, hey, yeah, I'm golfing 6 times a week, and other people are making decisions, but they don't really have something that has those processes or structure in place.
Yeah, I think that the best thing is actually to talk to the people that are running it when the founder's not there, right? Because if the founder might have a different opinion than the people that are making the decisions, right? The founder might say, everything's great, I'm playing golf, I don't need to be involved in the business, and the people that are running it might say, we don't have any direction, we're just kind of doing everything from the seat of our pants, and we have no systems in place, right? So it's getting a good understanding of, separating the bias from the owner of the business, but also from understanding the kind of the next level of management below the owner, to understand, how is the business running? Is it running well, or can it be running better? Right? What are the areas? And often, a lot of times, they won't tell the owner of the business that, because they're worried, right? If you think about it, they're worried about their job. They're, they don't want to share these things because they're worried about the reaction of a owner. Where I think the best advice you could get from, as being an entrepreneur, is advice from your staff and employees on how do you improve, right? Be self-reflective. Understand that you're not the best at everything. You might be better than a lot of people, but that doesn't make you, untouchable. There's always ways of improving, right? And sometimes they're hard to hear, just like when it's hard to hear from a business, or hard to hear that your business is worth less than what it might actually be. But it's important to understand that, because if you want to improve your business, you have to understand what that baseline is, right? And the same thing, no different than as an owner of a business. You need to understand the hard truths so that way you can fix those things, right? So it's I think those are all key things and very important all throughout.
No, well said. I know we're coming up on time here, so we've got two questions that we always like to ask our guests here on Build a Business Worth Buying. The first one is, what's the best example of a moat that you've seen another business build?
Oh, geez. Well, if you're in a very specialized subsector, right? So subsector of a subsector, and let's use transportation example. So if you're in, and I'll use an example like a LTL, so less than truckload, flatbed freight, which is not common, very uncommon, is very hard to do. But if you're able to do it, everyone's like, how do you do it? Like, everyone wants to know how to do it. Well, how do you know? Well, you buy this company and you can find out how to do it, right? So when you find a very specialized space that's not too specialized, it's kind of that fine line. Like, you don't want to be so
you need to
niche.
Have a market,
yeah, you need to have a market. You don't want to have a market of 1%, right? But let's say flatbed market in the U.S. and Canada is like 20% of all transportation. Well, that's still 20%. That's massive, right? Of trillions of dollars of freight. So you want to have a niche that's specific, that most people aren't in. And usually when things are difficult, that's a niche. When stuff is easy, everybody could do it, right? So the harder it is, the more niche it is, the more people pay for things, right? Because if you could find a solution to a major problem, people want to know how you did it. And that's the secret sauce, right? So, finding that niche of that example of having that, having, their own proprietary system, having their own program for their sales reps, like that was probably the best example of a moat, being very specialized in the type of freight they move, very specialized on how they keep their top sales reps there so they couldn't even get picked off by somebody else, and having good team dynamic where everyone was close together. So it was like a family, even though everyone was from different places and no one, different backgrounds, different, races, religions, everything, but everyone came together because there was this kind of stickiness nature of the culture that the business had. So that from a internal perspective, but even external, just the way that they operate and the type of shipments that they did was very unique and was very difficult, right? So it would be very hard for somebody to replicate that. That's why they were able to command a very good price when they sold, because most people wanted to replicate it and they wanted to pay for that replication. So that ended up being a great exit for them. And that the owner of that business did really well and a really good job. He was in his 30s when he sold it, and he was he was very smart and very methodical with how he did it. He didn't want to do what everybody did. He wanted to do what everybody didn't want to do. And the best thing you can do, ask any client, is saying, what are your biggest pain points? Walk me through them and let me figure out a way of solving them, right? And if I solve them, can you hire me to help solve them for you? Right. So those are the key things you want somebody to walk through with you.
That's great. And if you were to start today only knowing what you knew, and you weren't doing an M&A advisory business, but what would you do to start building something that someone else would want to buy one day?
I think the best thing to do is do something you love is number one, right? Like if don't go into space because it's sexy or interesting because somebody told you, you read it online. Get into something you like or love. Because if you do something that doesn't excite you, you're not going to put 100% effort in, right? So you got to do something you love, number one. Number two is find ways of being better than everybody else, right? And sometimes it's actually very simple. Communication, I would say, is probably the key, the most important thing. It's funny how much business we win versus like big firms or big banks, because all we do is we communicate. Right? Some people will say, hey, I haven't heard, our previous advisor took 3 weeks to get back to us. Like, that's crazy, right? When they asked you, can you get back to me tomorrow? And they took 3 weeks, right? And just no reason why it would take that long. So I think it's just doing some of the simple things that people just miss and they just take for granted. So I think as you're starting a business, just be very communicative, do something you love, and make sure when you're doing something, make sure that it's you're building the business with the anticipation one day it's going to sell. So as you're building these processes and systems, they're documented, you understand them, and it's not just in your head, but it's also on paper, right? Because it's really hard to take what's in your head on paper year 7 than it is when you're doing it at the time. So I think those are the key things as you're starting to build a business. Look at the end goal, even though that might not be your end goal, but just plan as if that's the way fashion you're going to do it. So that way the systems you're creating are going to be consistent with making sure everything is put in place correctly, right? So I think those would be the key things I would recommend for sure.
That's great. I guess a follow-up question is, you're kind of in a position where you are deciding which clients you want to take on. And so do you have the same criteria for clients that you want to represent either on the buy side or the sell side, where if they're not doing X, Y, and Z, you're like, look, I don't know if this is really a transaction here.
Absolutely. No, we do. So we, just as much as people look at us and vet us, whether we're the right party for them, we vet them too, right? And we're consistent about working with people of the right mind and the right mindset. If they don't act appropriately, if they don't listen and they don't take advice, it's really hard to work with somebody, like when our job is an advisory firm, that if somebody doesn't want to take advice from you, right? So then you're just going to be spinning your wheels consistently, never closing a transaction. So we find the people that are open to listening to our suggestions and taking our suggestions, that it makes sense for us to work with them. But if you could see them, like we've had multiple scenarios where we actually turn down a lot more people than we actually work with, because our goal is to transact, to close a transaction. And if we can't find a pathway there's no point in wasting anybody's time. We'd rather them work with somebody else that's maybe a better fit than with us, right? So because we're industry focused, and because we want to keep our track record pretty clean and pretty consistent, you can use that term, consistency, we want to be able to work with the right mindset and the right mindset of business owners. So if they don't fit into those realms, and you could probably see that right away. We do. We have sort of metrics we check ourselves to make sure. But if there's somebody that keeps changing meetings and keeps changing times, and you're on a call and they don't show up on time all the time, or they don't respect your time or don't respect your opinions, they're probably not going to be a client you want. And that, regardless of whether M&A, anybody else, like, you probably wouldn't want them as a client, right? And they probably wouldn't want themselves as their own client. They just don't know it yet. So sometimes the hard truth is, when you tell people no, here's somebody else you could probably work with better than us, and they ask us why, we're pretty honest with them. Say, look, there's a bunch of factors, and here's what they are. So it just might not be a good fit, and that's okay, right? Not everybody's meant to work with everybody, right? That's just not how the world works, right? So we try to be accommodating as much as we can, but there's, to a certain point, like, you want to be selective of, the people you work with, because our ultimate goal is to get a business sold or buy a business. And if we can't see that pathway, there's no point in spending 8-9 months spinning our wheels guessing, right? It's better to be upfront about it.
Great. Well, Peter, this has flown by. Thank you so much for making time. I know you're in between deals and doing a lot of stuff here. So thank you so much for being on a Build a Business Worth Buying.
Thank you. Pleasure again. Thank you again. Take care.
Thanks for joining me on Build a Business Worth Buying, brought to you by ISBA Consulting. I hope today's conversation gave you real insights into scaling smarter, selling better, and thinking like a strategic operator. If you found value in this episode, make sure to subscribe, leave a review, and share with someone who's building their own sellable business. Until next time, remember, the real win isn't just building a business, it's building one worth buying.